Hey guys, welcome back to the Bitcoin Fortress podcast. Today is March 1st, 2026. We are at block height 938901. Moscow time is 15:03 and fees are sitting at 1, 1, and 2. Calm mempool, quiet surface. But under the surface, markets are twitchy. ETF flows just flipped after weeks of bleeding. Mining difficulty just jumped 15%. Banks are building Bitcoin rails while politicians debate trade wars and the Fed tries to sound steady. In other words, the noise machine is loud. And this is exactly when perspective matters, because if you zoom out, Bitcoin doesn't care about tariff headlines. It doesn't care about Fed speeches. It doesn't care about election cycles. It keeps producing blocks every 10 minutes. And that's what we're here to do. Step back from the emotional swings. Look at what actually changed this week. So what are we going to cover? Well, glad you asked. Macro pressure and what it really means. ETF flows, are institutions back? Corporate treasury moves, mining difficulty shock, lightning adoption, and AI integration, El Salvador's next education push, and what the broader Bitcoin podcast universe is talking about right now. Then I'll feature this week's Substack piece, Bitcoin versus Political Cycles, because if this week proved anything, it's that liquidity and politics are deeply intertwined. If you want signal over noise, you're in the right place. Let's build the fortress. And with that, let's jump right into the news. First up, market plus macro. Bitcoin trades in the blast radius. A piece from Barron's on Trump tariff uncertainty and risk-off pressures. Market isn't trading Bitcoin, it's trading liquidity and risk posture. When macro gets punchy, Bitcoin gets treated like a high beta asset, especially short term. The useful takeaway isn't the exact tariff level, it's policy instability. Uncertainty tightens financial conditions even before a single dollar of tariff revenue is collected. If you're a long-term Bitcoiner, this is your weekly reminder that Bitcoin's monetary properties don't remove short-term macro reflexes, they outlast them. Watch how quickly narratives flip. Bitcoin gets called digital gold on the way up and risk tech on the way down. The truth is, it's a new monetary asset still being priced by old monetary regimes. And again, that was all in response to Bitcoin dropping below 65,000 last week. Fed officials, no imminent need to change policy. Rates steady. This is a piece from Reuters on the Fed signaling patience. This is the classic higher for longer vibe, or at least not cutting just because markets want it. Bitcoin hates two things in the short run, tight money and surprise tightening. Even the absence of cuts can feel like tightening when markets were positioned for easing. For Bitcoiners, the deeper point, every central bank meeting is basically a reminder that the global system runs on committee-managed money, which is exactly why Bitcoin exists. Next, we have Fed's Waller floating a possible pause depending on jobs data. This was from Reuters, talking about the March meeting coming up with the Fed. This is a data dependency week. Jobs report equals expectations reset. Bitcoin traders obsess over CPI and jobs because they're proxies for does the printer get closer or farther away. Long-term Bitcoin thesis doesn't need a dovish Fed, but the path, volatility, drawdowns, speed of adoption absolutely gets shaped by policy cycles. And of course, all it takes is a crisis to fire up the money printer, and then you get what you wanted, uh, which is fiat debasement. Interesting mirror market signal. Gold custody demand heats up. This also from Reuters on OCBC exploring physical gold custody as gold demand surges. This matters because it's the traditional safe haven playbook, custody, vaulting, institutional rails. Gold demand rising while Bitcoin chops is a reminder. Many allocators still treat Bitcoin as emerging and gold as settled. The long game is Bitcoin becoming the asset that doesn't require permissioned vault rails at all, self-custody as the final custody business model. And if you've studied Bitcoin long enough, like I have, you realize that it has all the benefits of gold and few, if any, of the drawbacks. ETFs and institutional flows. The whale is still in the pool is our next section. Spot Bitcoin ETFs, 5 straight weeks of outflows as of the February 20th week. This is from the block. ETFs are a sentiment and allocation valve for institutions. When they de-risk, Bitcoin feels it. And we've talked about this many, many times on the show. Great news when Bitcoin's going up, bad news when it's going down. But ETF flows are not Bitcoin adoption, they're paper allocation. It's important, but not the whole story. When outflows persist, it tells you institutions are prioritizing liquidity and balance sheet safety over upside. ETFs flipped 258 million of inflows on February 21st, first meaningful green day in a while. This from Cointelegraph on the inflow snapback. The key word, of course, being snapback. This looks like risk managers stopping the bleed, not euphoric new demand. Still, flows changing sign often precedes a narrative shift. Markets always love a turning point. So again, something to watch as we do every week. Bigger flip, 506.5 million inflows on February 25th as Bitcoin rebounds. This from Bitcoin Magazine on the big day. This is the institutional bid returns headline week. Don't overfit one day though. Do respect it. ETFs are the marginal buyer during stress. If the outflow streak was risk off, then a day like this is risk on, testing the water. Broader context, ETFs had been bleeding billions. What to watch next? This from MarketWatch on ETF outflows and key support zones. The practical use, this frames levels and psychology. When flows are negative, price levels become reflexive, break support, force selling, worse flows. And so the translation for all of us is short-term plumbing can overpower long-term fundamentals temporarily, and that's why you have to stay humble and stack sats and put it in cold storage. And if you have to, turn off the ticker. Don't look at the price. Just chill. All right, moving right along to corporate Bitcoin and TradFi integration. Rails are being built in public. And as we talk about almost every week, Strategy keeps buying 592 Bitcoin for the week ending February 22nd, despite being underwater. This is an article from MarketWatch on their continued buying. So, whether you love it or hate it, Strategy is basically running a public levered Bitcoin accumulation experiment. The signal isn't Saylor is bullish. The signal is a corporate entity is structurally committed to accumulating through cycles. And they do. They buy at every price on the way up and every price on the way down. So when Bitcoin drops, leveraged proxies can get hit harder. So watch the second order effects, equity volatility, funding conditions, and sentiment spillover. Next, we have a smaller but telling treasury story. DDC surpasses 2,000 Bitcoin. This was from the NASDAQ Business Wire press release on DDC's holdings. This is the Bitcoin treasury playbook spreading beyond the one famous name. These firms are effectively saying cash is melting and we want a hard reserve asset. The meta trend, more treasuries, more public discussion, more normalized ownership, more demand for custody, and reporting rails. Next, banking moves. So Morgan Stanley publicly talking about full stack Bitcoin services. And this is from Bankless Times. So this is a big deal, even if timelines slip. When a bank that large talks about custody and trading and lending, they're admitting clients want native exposure, not just ETFs. The yield word matters. TradFi always tries to financialize everything. And of course, caution for Bitcoiners, yield plus rehypothecation risks come back fast. If it's not your keys, it's not really yours. So while that's nice and maybe useful for part of your stack, I would still probably want to keep almost everything in cold storage with my hands on the keys, because I just don't trust the banksters. Call me crazy. Next, we have banks pushing deeper into crypto infrastructure, stablecoins, custody charters, direct rails. This from Coin360 roundup of regulated bank initiatives. Even if you ignore the altcoin noise in bank strategies, the takeaway is simple. Institutions are building the pipes. Pipes don't guarantee adoption, but they do reduce friction. Bitcoiners should watch for custody standards, proof of reserves culture, and whether users get pushed into paper claims versus real ownership. Moving right along, we are at mining and infrastructure. Difficulty whiplash, margins tight. So the Bitcoin mining difficulty jumped 15% to 144.4 terahash as hash rate rebounds. This from the block on the big difficulty jump. This is Bitcoin's anti-fragility in one chart. Hash goes down, difficulty adjusts, miners stabilize, hash comes back, difficulty snaps higher. A 15% jump is not just trivia. It's competitive pressure returning fast. This squeezes high-cost miners and rewards the efficient. That's the system doing selection, and it's all automatic and in the code. Such a beautiful thing. Next, we have public miner pivot vibes, Mara plus data center AI infrastructure angle. Investors.com on the Mara partnership, AI plans, and miner earnings context. The mining industry is increasingly two businesses: Bitcoin production, power and data center monetization, high performance computing / AI. In a weak hash price environment, miners chase revenue diversification. The Bitcoiner frame: even if miners diversify, Bitcoin remains the anchor, buyer of last resort for stranded and curtailed energy. Political celebrity adjacent miner headline: American Bitcoin quarterly loss. Reuters covering their swing to a loss this quarter. This is a case study in how mining P&L gets crushed when Bitcoin reprices fast. The important part isn't the last name, it's the reminder. Mining equities are operating leverage and Bitcoin beta. For listeners, if you want Bitcoin exposure, understand the difference between owning Bitcoin yourself, owning miner equity, owning levered treasury proxies. They behave very differently in drawdowns. Moving right along, we are at Lightning and real-world usage. Payments quietly keep working. First up here, Lightning Network, 5,000 payments in 8 hours at a Las Vegas event. This is an AOL write-up referencing conference Lightning payment volume. I like stories like this because they're not theoretical TPS wars, they're actual usage. Lightning success looks boring. Fast payments, low fees, nobody cares, but that's the goal. The bigger narrative shift: Bitcoin base layer stays settlement. Lightning does commerce, that division of labor. is becoming more intuitive to normies. And of course, as we all probably know, that's how the internet got built, in layers. And you don't ask each layer to do all things. Lightning Labs rolls out AI agent tools for Lightning transactions. This is from Bitcoin Magazine on Lightning Labs AI agent toolkit. This is the machine economy thread. If AI agents can transact, you need money native to the internet, and Lightning is a strong candidate rail. A key philosophical point here, tools that enable agents to pay without identity, KYC style onboarding, highlight Bitcoin's unique property, authentication without permission. Even if this is early, it's the right direction. Composable, open source payment primitives. Next, we have sovereign nation state adoption. El Salvador keeps building. El Salvador revamps its Bitcoin education, Bitcoin Diploma 2.0 into public schools, and this is a 2026 rollout. Yahoo Diario El Salvador coverage of the updated program. This matters more than a one-day price move. A sovereign integrating Bitcoin education is a generational bet. Education is downstream of values. They're trying to normalize monetary literacy and digital sovereignty early. Whether you agree with every policy choice there or not, Bitcoin education at scale is a real-world adoption lever. Moving into regulation, politics adjacent, rules shape rails, the new CFTC chair profile and prediction markets heat, and why Bitcoiners should care. From Business Insider, prediction markets aren't Bitcoin, but they sit in the same bucket. Financial innovation colliding with regulatory turf wars. The meta lesson, the state often tries to decide what kinds of markets are allowed. Bitcoin is the market that routes around that. For Bitcoiners, it's another reminder that regulatory posture can change quickly with administrations. So, build your strategy on self-custody and resilience, not political moods. Stay frosty out there. All right, now let's take a look at the Bitcoin podcast universe themes for the week. Theme 1, lightning scaling is real, but UX is still the battleground. So from the Stefan Livera podcast, SLP 725, 1 billion monthly volume on Lightning with Sam Wouters from River. Lightning keeps improving. The debate shifts from does it work to can normal people actually use it? Also, Stefan Livera podcast, SLP 726, will stablecoins help in Bitcoin adoption with Gareth Grobler. Stablecoin demand is huge. Bitcoiners should separate Bitcoin the asset from Bitcoin the rail conversations. Second theme of the week, on-chain spam, inscriptions, protocol policy debates will not die. Also, Stefan Livera podcast 724, Bitcoin spam debates with Charlie Spears. Blockspace is a market. Social consensus fights about what it should go on chain will continue to recur. Theme 3 of the week, AI plus Bitcoin is accelerating from meme to tooling. TFTC 721, the human skills that matter now that AI can code with Kali. If AI changes how value is produced, it also changes how value moves. Payments become programmable and continuous. Also on the same theme, Bitcoin Audible, read 933, the secret to vibe coding. Agent workflows are real. They're pushing the need for internet native money rails. The fourth theme of the week, big picture cycle skepticism, the political plus liquidity reflex lens. The Bitcoin podcast showed some recent releases and ongoing macro cycle discourse. More podcasters are questioning simple four-year narratives and focusing on liquidity, policy, and institutional structure. And finally, Safety and Amos continues the time preference education lane with the Bitcoin Standard Podcast, episode 312, Principles of Economics, lecture 3, Time. Bitcoin is a technology, rewards lower time preference. Stacking sats is a life philosophy, not a trade. So again, I'll put links in the show notes to this and all the articles that I cover. Check it out if you're interested. Did want to cover this week's featured Substack post, Bitcoin versus political cycles. This is kind of a start of a new thing on the Bitcoin Fortress Substack, where I'm doing deeper dives in smaller volume of articles going forward. So I'll have a couple how-to videos. I've been focusing lately on privacy a week, and then a nice long form post on a particular topic. So this was the first one, Bitcoin versus political cycles. And it's about how markets get whipsawed by elections, policy incentives, and liquidity reflexes, and why Bitcoin ends up being the scoreboard for credibility over time. If you've ever felt like price action is just politics with candles, that one is for you. And again, I'm going to continue with this series initially for 12 weeks, and then we'll roll into a different theme. So check that out, link in the show notes. Quick reminder, if you want to go deeper, 3 books that I've published under the Bitcoin Fortress banner: Bitcoin Fortress, A Simple Guide to Bitcoin for Beginners; Bitcoin Retirement and Estate Planning, a little bit more advanced topic; and The Bitcoin Lifestyle, How to Make Your Life Better with Bitcoin. All right, that wraps up episode 205. If you've got value from this, share it with one person who's trying to make sense out of the noise. Stay humble, stack sats, and build your life like you're building a fortress, one block at a time. Talk to you all next week. Bye-bye.